While 2020 has been the most challenging of years, the resilience of Weir has once again shone through. We acted early and decisively to protect the group's financial position from COVID-19, targeting £39 million of cost savings across the continuing group and extending liquidity through the refinancing of our RCF and term loan. As the year unfolded, it became clear that mining was deemed an essential industry. Therefore, after about a 15% impact on ore production in the second quarter, activity quickly recovered to close to normal levels. While we suffered some disruption to our operations, we were always able to fulfil customer orders. This resulted in an extremely resilient performance, with orders down 9% at £1.9 billion, revenues down only 1%, and adjusted operating profit flat at £305 million in constant currency. The total group reported loss after tax of £149 million mainly reflects the non-cash impairment to the oil and gas division to bring the carrying value into line with the agreed disposal proceeds. Operating cash flow at £372 million was strong, with working capital efficient at 22.9% of sales. This excellent cash performance, together with the agreed sale of oil and gas, means net debt to EBITDA on a pro forma basis, excluding oil and gas, is 1.7 times. Looking at the minerals division, the aftermarket once again showed great resilience, with orders down 4%, in line with ore production, while revenues increased 4%, reflecting the delivery of the majority of the £100 million Iron Bridge contract secured in 2019. Operating profit was flat at £260 million, with the impact of COVID disruption and forced shutdown to a number of our facilities being offset by the £30 million of COVID cost savings. Operating margin at 17.7% was 70 basis points lower than last year due to a higher OE mix, but still in line with our normal range. As COVID impacts lessened as the year went on, orders improved sequentially in quarter 4, up 17% versus quarter 3. Aftermarket up 7% and OE up 45%, with a number of large integrated solutions orders for copper and gold projects being signed in December. Turning to ESCO, they faced similar mining market conditions to minerals, but with a greater infrastructure exposure, saw orders down 15% and revenues down 13%. This was due to many infrastructure projects in Europe and the US being shut down during the second and third quarters especially. Mining orders were more robust, down 10%, including a degree of destocking by customers as our lead times reduced. Like minerals, orders improved sequentially in Q4, up 7%. We continue to be delighted with the margin performance of ESCO since acquisition. Operating margins at 16.3% were up 180 basis points on last year and are up more than 500 basis points since acquisition. This has been supported by full delivery of cost synergies and operational efficiency improvements, as well as £9 million of COVID savings. This strong margin performance meant that operating profits proved resilient, only £2 million lower than last year at £81 million. After the sale of oil and gas, we look forward as a mining technology pure play and aim to grow revenues faster than our markets and see our group margins progress by 150 basis points over the next 3 years. This will be delivered within a strict capital allocation framework, which firstly will see us invest in organic growth to achieve above market growth and margin progression. Secondly, we will keep net debt to EBITDA between 0.5 and 1.5 times and aim to have a fully investment grade credit rating. Thirdly, we will pursue selective M&A to accelerate our strategy, only where we see returns ahead of our cost of capital within 3 years. And lastly, we will look to pay a dividend of 33% of EPS through the cycle. In summary, while challenging on many fronts, 2020 was a year of strong execution. Alongside the disposal of oil and gas, the group was able to demonstrate its great resilience, with revenues and operating profits broadly maintained, while our refinancing extended our liquidity maturity profile, and with significantly reduced leverage, we look to the future with great confidence.